2 to 3 years of annual spending not covered by guaranteed income is the retirement cash buffer that turns the dangerous part of a historic market crash into a manageable event. If your spending gap is $50,000 a year, that means $100,000 to $150,000 in cash, with $125,000 as the practical midpoint. And each missing year can be brutally expensive. If stocks are down 50%, one uncovered $50,000 withdrawal from a stock portfolio originally worth $1 million requires selling roughly 10% of the shares you originally owned. No cash across 2 model withdrawals means roughly 20% of your original shares can disappear while prices are depressed. The answer is not 10 years of cash. It is not 6 months either. The useful zone is 2 to 3 years. Protection begins flattening after year 3, and somewhere around 4 to 5 years, another year of cash usually starts costing more than it protects against the historical crash windows we can measure. The amount is based on your spending gap, not your total spending. Suppose your retirement lifestyle costs $70,000 a year. Social Security covers $24,000. A pension covers another $6,000. Your portfolio is responsible for $40,000. Multiply that $40,000 gap by 2.5, and your midpoint reserve is $100,000. Using $70,000 would produce $175,000, meaning you would have parked an unnecessary $75,000 in cash because you counted expenses that guaranteed income was already paying. Guaranteed income means income that does not depend on selling market assets at that moment. Social Security and a defined benefit pension are the obvious examples. Reliable income from work can count while it continues. Although, I would not build a 30-year retirement system around the assumption that you will always feel like working. Rental income deserves more caution because vacancies, repairs, and unpleasant plumbing surprises tend not to respect spreadsheets. Use the amount you can reasonably expect after ongoing costs, not the beautiful gross income number displayed before the roof starts leaking. The phrase non-event also needs a boundary. It does not mean your account never declines. You may still open the statement and see a number that causes you to develop strong opinions about financial television. It does not mean that cash must carry you all the way back to a new market record. And no finite reserve can guarantee protection against every crisis the future might invent. A crash becomes a non-event operationally when you are not forced to sell stocks near the trough to fund ordinary living expenses. The market decline remains real. The permanent withdrawal damage does not have to be. By the way, if you appreciate finance explained with actual numbers rather than an ominous thumbnail and a man pointing at a red arrow, clicking subscribe helps a lot. Thanks to everyone who does. Now put $1 million into a stock sleeve before a severe decline. Your annual spending gap is $50,000. Before the crash, that withdrawal equals 5% of the original portfolio value. For clean math, imagine you own 100 equal units worth $10,000 each. Funding $50,000 requires selling 5 units. You retain 95, then prices fall 50%. Each unit is now worth $5,000. Your next $50,000 withdrawal requires 10 units. The expense did not double. The number of shares sacrificed did. That denominator matters. You are not selling 10% of whatever share count happens to remain in some vague sense. You are selling an amount equal to 10% of the original 100 units. The decline has doubled the ownership cost of the same lifestyle. Real markets do not fall in a perfectly straight line. Pause at exactly 50% and politely schedule your withdrawal at the bottom. Dividends, taxes, bond returns, and monthly spending complicate the path. This controlled model isolates the mechanism that your cash reserve is intended to interrupt. Imagine the market takes 2 spending years to reach and pass through its dangerous trough window. With 2 years of cash, you fund $100,000 of expenses without touching the depressed stock sleeve. Your cash gauge reaches 0, but the original 100 stock units are still there. With 1 year of cash, the initial $50,000 comes from the reserve. That buys 12 months. The second annual withdrawal arrives after the reserve is empty and the market is down 50%. Raising $50,000 now removes 10 of the original 100 stock units. With no reserve, two $50,000 withdrawals made around the model trough price remove approximately 20 original units. 2 years of cash leaves 100 units participating in the rebound. 1 year leaves 90. No cash leaves 80. That is the simplified damage ladder. 2 years produces no trough period stock sales. 1 missing year costs roughly 10% of the original shares. 2 missing years cost roughly 20% under the same assumptions. Each uncovered withdrawal at the trough does not double all previous damage. It uses twice as many shares as the same dollar withdrawal would have required before the crash. The damage accumulates because the shares leave the account permanently. Suppose the market eventually doubles from the trough and returns to its old price. The retiree who kept 100 units again has stock worth $1 million. The retiree with 90 units has $900,000. The retiree with 80 has $800,000. The index recovered. Their ownership did not. This is why sequence of returns risk is more than seeing an ugly account balance. A temporary price decline collides with withdrawals and changes the number of assets available for the recovery. Once those shares have funded groceries, taxes, insurance, and electricity, a later bull market cannot call them back. I have spent more than 10 years running my own business around accountants and fiscal lawyers, and one lesson appears everywhere money moves. Timing can matter as much as the final total. Retirement is an especially annoying example because two people can earn similar average returns and end with radically different outcomes depending on when the bad years arrive. The cash buffer changes the timing. It does not defeat a bear market. It gives you permission to leave depressed ownership alone while the clock runs toward the trough. The obvious question is whether 2 years of runway has any relationship to real history. During the financial crisis, the S&P 500 price index fell approximately 56.8% from October 9th, 2007 to March 9th, 2009. The journey from peak to trough lasted 517 calendar days. That is roughly 17 months. A 2-year reserve would have extended beyond that trough with about 7 months of spending capacity remaining. The account would still have looked terrible. Ordinary withdrawals would not have required selling stocks around the lowest point of that decline. That case makes 2 years look strong, but the technology crash creates the harder boundary. From March 24th, 2000 through October 9th, 2002. The S&P 500 price index fell approximately 49.1%. The trip to the trough lasted 929 days. That is a little over 30 months. 2 years of cash would have expired roughly 6 months before the bottom. A 2.5-year reserve lands near the trough. 3 years gets through it with additional breathing room. Now, the opening range has a reason. 2 years covers the financial crisis descent. The slower technology collapse pushes the robust end toward 3. These are historical boundary tests, not a forecast that the next decline will copy either one. A future bear market could bottom more quickly. The pandemic decline did. Another could grind lower for longer. The point is not to predict its shape. The point is to choose a reserve large enough to span the dangerous trough windows of 2 severe modern declines without pretending unlimited cash is free. The recovery clock creates confusion because it is much longer than the trough clock. The technology era index level took more than 7 years from the original peak to establish a new closing high. The financial crisis peak was not exceeded until about 5.5 years after it was set. Measured from their troughs, both recoveries still took roughly 4 to 5 years. If you decide cash must cover the full period from peak to a new record, you quickly end up demanding 5, 6, or 7 years of spending in cash. That solves a different problem at a very high price. Your reserve's main job is not to wait for a ceremonial new high on television. It is to prevent withdrawals at the prices where each dollar consumes the most shares. Once the market is meaningfully off the bottom, withdrawals, rebalancing, spending adjustments, dividends, and other stabilizing assets can handle the later recovery years. That is where cash and bonds receive different jobs. Cash provides immediate spending runway with very little price uncertainty. A short or intermediate bond layer can provide a separate bridge beyond that runway, although bonds can fluctuate and are not identical to cash. Some bucket frameworks hold 1 or 2 years of expenses in cash, and another 5 to 8 years in high-quality fixed income assets. Our severe trough test supports moving the true cash target toward 2 to 3 years, when the goal is specifically to avoid stock sales near those modern historical bottoms. That does not require putting a decade of retirement spending into a checking account. It means the next withdrawals have somewhere else to come from, while longer-term assets retain time to recover. The exit code, the digital book I built from 50 years of retirement data, deals with this same problem from the full plan side, how your reserve, withdrawal method, and retirement date interact when markets refuse to cooperate. There is a link in the description if you want the mathematical framework rather than a collection of disconnected rules. Crash timing is why this protection matters much more around retirement than it did during your working years. A 50% decline while you are still earning may be emotionally unpleasant, but your salary can fund your lifestyle. New contributions may even buy more shares at lower prices. Move the same decline into the opening year of retirement and the market loss collides with a portfolio withdrawal immediately. You have no new salary contribution arriving to replace the shares. The account is being asked to absorb a price shock and produce income at the same time. Move that crash into year 9 after several favorable years, and the portfolio may have grown substantially before the decline. Your $50,000 spending gap might now represent a much smaller percentage of the enlarged balance. Earlier withdrawals may also have been funded from gains rather than deep losses. The market decline can be identical, while the retirement damage is completely different. Sequence risk is the interaction between the return and the withdrawal, not the return alone. Morningstar tested this timing problem using retirement simulations. Among failed all-stock trials, nearly 70% had already experienced portfolio losses by the end of year 5. A gain during the opening year cut the subsequent failure risk approximately in half. That does not mean year 6 is magical, or that an all-stock portfolio represents every retiree. It means the beginning of retirement carries disproportionate influence because the initial account value has not had time to build a cushion, while withdrawals have already started removing capital. This is also a brain problem. During your career, a market decline can feel like discounted shopping because income is still arriving. In retirement, the same screen is displaying the money intended to fund the rest of your life. The instinct to stop the pain becomes much louder precisely when selling does the greatest ownership damage. Cash lowers the number of decisions that must be made under stress. Your food budget does not require an opinion about whether the market has bottomed. Your property tax does not depend on a central bank press conference. You have time, which is the scarce asset during a panic. At this point, holding 5 or 10 years in cash can sound even safer. More runway must mean more protection. That logic works only until the runway has already crossed the dangerous window. Going from no reserve to 1 year prevents one possible trough withdrawal. Moving from 1 year to 2 may prevent another. Extending from 2 years toward 3 protects against a slower descent like the technology crash. The protection curve is steep across those additions. Once you already have 3 years, the 4th year cannot prevent the same trough sale a second time. It may help against a longer event, unexpected expenses, or unusually rigid spending, but its marginal historical protection is much smaller. By 4 or 5 years, you need a specific reason for every additional dollar, because the curve has become fairly flat against the crashes being tested. This is the midpoint change in the entire decision. Cash was protecting your shares. Now excess cash begins competing with them. Traditional retirement guidance tends to ask how much you can withdraw and which percentage belongs in stocks or bonds. The famous 4% rule gives you a starting spending framework. It does not tell you which asset should fund that withdrawal when stocks are down 50%. A sustainable withdrawal rate and a functional withdrawal system are not the same thing. Knowing these numbers and building a system around them are 2 different jobs. I built a digital book called The Exit Code because scattered retirement rules become dangerous when they collide. It is an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. For a crash problem like this, the relevant pieces are the 4% trap and the dynamic withdrawal method that replaces fixed automatic selling with a responsive spending system, plus the lazy portfolio framework designed to preserve long-term participation instead of turning every headline into a trade. It also turns the assumptions into a specific retirement date, So the buffer is connected to the rest of your plan rather than floating in a separate account. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description. Every year you delay the system is another year inflation and market timing get to make decisions for you. The cost of excess cash begins with inflation. As of August 7th, 2026, the 3-month Treasury yield was approximately 3.87%. The latest available consumer price index reading before the July release showed prices up 3.5% over the year ending in June. Those numbers are close. Before taxes, cash near the upper end of available yields was barely producing meaningful real growth. Cash earning less than that was losing purchasing power. And the July inflation number was scheduled for August 12th, so claiming newer data before its release would be creative writing, not research. Current yields also do not lock themselves in for 30 years. If short-term rates fall, cash income falls as holdings mature and reset. Inflation can move in the opposite direction. A reserve has to remain useful, even when today's relatively decent cash yield disappears. Nominal stability can therefore be deceptive. $100,000 still looks like $100,000 on the statement, while the amount of healthcare, housing, food, and travel it buys quietly changes underneath it. The number stayed still, your life did not. Inflation is only part of the price. New York University professor Aswath Damodaran's updated historical data shows that from 1928 through 2025, the S&P 500, with dividends compounded at roughly 10% annually, while 3-month Treasury bills compounded at roughly 3.4%. That historical difference is about 6.5 percentage points a year. You should not treat it as a promised future return. Stocks can underperform for years, and the exact future gap is unknowable. For planning, using a more conservative expected opportunity gap of 4 to 6 percentage points makes the trade-off visible without pretending history owes you a repeat. Every unnecessary $100,000 held in cash can therefore represent about $4,000 to $6,000 of expected annual return surrendered over a long horizon. It may be worth paying that cost when the cash is preventing forced sales. It is much harder to defend after the additional protection has flattened. Cash is insurance you finance through lower expected growth. The correct amount is not the largest amount that makes you feel calm during breakfast. It is the smallest, robust amount that lets the withdrawal system continue working during the period when selling stocks would do the most damage. Now overlay the two curves. Protection rises sharply from 0 through 2 years. It continues rising toward 3 because of slower declines, such as the 929-day technology crash. Beyond year 3, each added year buys less protection against the historical troughs, while carrying the same inflation and opportunity cost. That creates a central decision zone of 2 to 3 years. 2.5 years is the clean working midpoint. 4 to 5 years is an upper boundary for retirees with unusual vulnerability, not the default destination. Beyond 5 years, more cash should never be labeled automatically safer. The next crash could exceed these examples. That objection is completely fair. The response is not to assume that 15 years of cash has no cost. Longer crises are managed through multiple defenses. Guaranteed income continues covering part of spending. Discretionary expenses can be reduced. Cash handles the immediate withdrawals. And stabilizing assets can support the bridge beyond it. Each defense funds a different portion of the timeline. Treating cash as the answer to every possible future condition forces one low-return asset to do jobs it was never designed to do. Your place within the range depends on how close you are to portfolio withdrawals. If you are still approaching retirement and your paycheck covers your spending, the main need is emergency liquidity rather than a full retirement buffer. Roughly 1 year becomes reasonable for many late career households because an unexpected job loss can move retirement forward before the portfolio is prepared. The Employee Benefit Research Institute's 2026 survey found that 48% of retirees stopped working earlier than planned. 3/4 of those early retirements involve reasons outside the retiree's control, including health problems and changes at work. That is why the reserve cannot appear on the morning after your retirement party. Liquidity needs to be built before your chosen date, while income still gives you the ability to fill it without selling investments at an inconvenient moment. Once regular portfolio withdrawals begin, the exposure changes. The emergency fund is now also a timing reserve. This is where 2 to 3 years of net spending becomes the central range, especially during the opening 5 years when the portfolio is most sensitive to poor return order. If guaranteed income covers most of your essentials, you can lean toward the low end. Imagine total expenses of $80,000, with Social Security and pensions covering $60,000. Your gap is $20,000. 2 years is $40,000, and the midpoint is $50,000. You also have flexibility. If markets fall, travel or major discretionary purchases can be delayed without affecting housing, food, utilities, or healthcare. That ability to reduce withdrawals temporarily behaves like an additional reserve without requiring every possible dollar to sit in cash. In some strong income, highly flexible situations, 1 to 2 years may be defensible. You are accepting more market timing risk, but the spending floor is covered and the remaining withdrawal can bend. A retiree with limited guaranteed income faces the opposite structure. Suppose expenses are $70,000 and Social Security covers $20,000. The gap is $50,000. If nearly all of that spending is essential and difficult to reduce, moving toward 3 years means $150,000 of runway. 4 to 5 years can be justified when you can name the specific vulnerability. Maybe your guaranteed income is unusually small. Maybe a large healthcare or housing expense is highly likely. Maybe your withdrawal percentage is already elevated. Maybe your capacity to cut spending is close to zero. Even then, the entire 4 or 5 years does not necessarily need to perform the identical cash function. Part may be true immediate liquidity, while a separate short duration bond layer handles later withdrawals. The division depends on liquidity needs, taxes, and how much fluctuation you can tolerate in the bridge assets. A very early retiree still needs the 2 to 3 year timing buffer, but excess cash becomes more costly because the retirement may last 40 years. Holding 10 years of expenses in cash at age 50 is not merely a safety choice. It is a multi-decade decision to reduce the amount participating in growth. Later in retirement, the gap may shrink. Social Security may begin. A pension may start. A mortgage might disappear. Spending patterns can change. If guaranteed income rises from $30,000 to $45,000 while expenses remain $70,000, the portfolio gap falls from $40,000 to $25,000. At the midpoint, the required reserve falls from $100,000 to $62,500. The multiplier did not change. Your income structure did. The reserve should be recalculated rather than preserved as a sacred dollar amount. Inflation may raise spending. Guaranteed income adjustments may cover part of that increase. Large one-time expenses should be separated from the recurring annual gap, so a planned roof replacement does not masquerade as permanent retirement spending. Refilling the buffer also requires judgment. In strong market years, gains can replenish cash that has been spent. During weak years, the reserve is supposed to decline. Selling stocks every month to keep the cash bucket perfectly full while the market is collapsing defeats its purpose with impressive efficiency. The reserve is a gauge, not a decorative account balance. Spending runs it down when markets are weak. Favorable periods create opportunities to refill it. The process avoids turning every withdrawal into a prediction about tomorrow's closing price. There's a psychological boundary as well. Too little cash makes every market decline feel like an immediate threat to your lifestyle. Too much can make you terrified of deploying or spending any of it because the large number itself becomes emotional security. That is how someone ends up with 8 years of expenses in cash, worries constantly about inflation, refuses to invest the excess, and still does not feel safe. The brain moved the goalpost because there was no stopping rule. Your stopping rule is the point where the next cash year no longer covers a historically relevant trough window that was previously exposed. Around year 3, that benefit has largely been captured by the cases we examined. The 4th and 5th years require personal evidence. Beyond that, opportunity cost normally dominates the historical crash protection being purchased. By the way, if this type of threshold helps you make an actual decision, subscribing is a quiet way to support the channel. I appreciate everyone clicking it. Return to the $50,000 spending gap. With no cash and 2 modeled withdrawals at a 50% trough, approximately 20% of the original shares are sold. With 1 year, roughly 10% are sold. With 2 years, the simplified trough period sales fall to 0 in the financial crisis length test. Moving toward 3 years covers the longer technology crash descent. The midpoint is $125,000. That is 30 months of net spending runway. 5 years means $250,000 in cash. Compared with a 2.5-year midpoint, you are holding an extra $125,000. At a 4 to 6 percentage point expected opportunity gap, that excess can surrender roughly $5,000 to $7,500 a year in expected return. Over 10 years, ignoring compounding, that is $50,000 to $75,000. With compounding, the potential difference grows. The 5th year of cash may feel safer, but you are paying a recurring price for protection that the first 3 years have already largely delivered against these historical troughs. This is the threshold that matters. Below the target, missing cash can permanently remove shares near the bottom. Above the target, excess cash can permanently reduce the growth available to fund later retirement. One side exposes you to bad timing now, the other exposes you to insufficient growth later. The correct buffer sits between them. Take your annual expenses and subtract guaranteed annual income. Multiply the gap by 2 for the lower boundary and 3 for the robust upper end. Multiply by 2.5 when you want one working number. A $30,000 gap produces a midpoint of $75,000. $40,000 produces $100,000. $60,000 produces $150,000. An $80,000 gap produces $200,000. Then ask whether your spending is flexible, whether essentials are covered by guaranteed income, whether withdrawals are already high relative to the portfolio, and whether you are entering the vulnerable opening years. Those answers move you within the range. They do not erase the cost of moving far beyond it. Cash is not dead money when it prevents you from selling 10% of your original shares at half price. It becomes expensive money when it sits there for decades after its protective job has already been funded. The goal is not to feel nothing when markets fall. The goal is to ensure fear never receives signing authority over your portfolio. Lazy investing built more fortune than crypto memes. A 2.5-year reserve will not predict the next crash, but it can make the prediction irrelevant to your next withdrawal. Annual expenses minus guaranteed income multiplied by 2.5. Keep 4 to 5 years only when you can name the exact risk you are paying to cover. Anything beyond that is not automatically safety. It is a very expensive form of waiting.